Welcome to the daily update, where I'll go over the action in the market for Tuesday, August 13th. Then we'll see how things look for Wednesday, August 14th. Saw a really positive reaction to the PPI that came out. It did come in up, so that shows the economy's not falling apart. But the core PPI came in unchanged, which was lower than expected. So it's also showing that inflation, at least at the producer level, is not a problem. Now we're going to have CPI coming out on Wednesday. That's the big report. And we'll see if this shift that we're seeing to going back and looking more positive can continue. There'll be a real reaction to this report when it comes out. We don't know if it's going to be positive or negative, but it could be starting to change the scenario a little bit where we're going back and looking more at growth, seeing an improvement. We're seeing the mega caps doing a bit better. We're seeing the bigger stocks starting to outperform a bit compared to the rest of the market. And that's what really helps the indexes go higher. I do have a thing called the SPXInvesting Program. If you want to learn more about it, there is a link below this video that will take you to the website as well as to more videos. And here's an email address where you can contact me. This daily video is only one video that I do, but it's the foundation of all the analysis and commentary that I prepare, where all of the other videos, they're meant to supplement into the daily video. So let's go back and talk about what happened. Right at the open, we had a gap higher open. Now the futures were pretty strong. Not really strong. There was a real anticipation for the PPI to come out, but then we did see a real move higher after the report came out, and we opened above R1 at 53.69 as well as R2 at 53.98. So we're back to dealing with that 5400 level, at least at the open. And then we fell back just for a short time back below R2. Then we kept going. We were able to get above 5400. There wasn't any real significant selling pressure as we kept going up, but we didn't get all the way up to R3 at 54.40, yet we did close at the intraday high. We were up 1.68% on below average volume. Now that is a concern. The bounce that we've been seeing since we saw the big decline a week ago Monday, we've been inching our way back and the charts have been showing some improvement, but pretty much this whole climb has been on below average volume. And so we just need to be aware of that. We like to see an expansion of volume when stock is going up if we're going to turn more positive. But we're still negative in the short and intermediate term, but we're possibly in the process of switching over and becoming positive. At least that's what it looks like right now. Now, CPI could come out. We could have a negative reaction to that. That could boost up volume. It could be selling volume, and it could send everything back lower. But for right now, we are seeing a gradual shift back in our charts, but they're not quite over to looking positive yet. And Wednesday, it'll be about inflation, which ultimately will be about interest rates, which continue to decline. That's the big report of the month there. And we want to keep an eye on the geopolitical things that are happening. So far, there hasn't really been much of an escalation in the Middle East, which we got beyond the 9th of Av, which is a very sad day in Jewish and Israelite history. Nothing seems to really have escalated too much. I mean, there's always strife and there's problems and there's rocket attacks and things like that. But a large scale escalation doesn't seem to have developed, at least yet. But we want to still keep an eye on that, especially how it could impact the stock market. And we want to keep an eye on oil, which actually declined in Tuesday's session. So some comments. There was real positive response to the PPI when it came out. We're back above 5,400 with the S&P, and the VIX is back down below 20. So after really spiking up, it's been making its way lower for the most part. On a short-term basis, we actually have a couple of extreme positive readings. We look at the rate of change going back 5 days. That is looking extreme positive, and the Stochk RSI is now extreme positive. In the intermediate term, we have the Connors RSI, which is not an indicator we see all that often, but it's looking extreme, and I'll show you that. And then long-term, we have the rate of change going back 200 periods. It's starting to look a little extreme as well. Now, if we are switching back and looking more positive right now, these could be signs of good momentum, because when we're in a longer term uptrend and we do surge to the upside or move to the upside, some of these indicators can become extreme and stay that way for a while. And one thing that I did make a change in here is the current scenario, that there was this concern about economic growth that seems to be going away now, but that could come back at any time. It's just as of Tuesday, the market's like, okay, maybe the economy's not falling apart. Inflation seems to be coming down. The market is anticipating that there'll be a rate cut in September. There's a 100% chance that the market thinks that's going to happen. It's just how much is the Fed going to actually cut rates at that meeting? The dollar, it was actually down a bit here. I forgot to change that from unchanged. And interest rates were also down. We continue to decline with the 10-year yield. We're down at 3.85%, where after Monday we were at 3.91%. We're still inverted with the yield curves, but the 10 to the 2-year, it's getting close. It's not there yet, but it's getting close to going back to switching to normal. And sentiment is still extreme negative. Even with the up day, we're not seeing a real change in that, at least yet. We're right at 25, which is the border of extreme negative. So we can tend to use that as a contrarian indicator, where after Monday we had been at 24. There was some updates later on that even put it down to 23. I'm not sure how CNN Money updates. It seems to be different every time I go to that page. We are seeing a bit of a change here with our trend. We're still negative with the trend. The red line's on top, but it's declining. But the ADX is now weakening. It's dropped below its moving average. But we're still above 20, so we're still in a trending environment, but it could be a weakening trending environment. And with the up day, the bias is positive. And the last number of days, I've changed from mixed over to positive now, because we've seen a nice little bounce since we saw that decline a week ago Monday. Economic reports, we did get the NFIB small business optimism. It came in higher than last time, where it had been at 91.5. Now it came in at 93.7. The big one, and this is from the inflation focus here, the core PPI came in unchanged. They expected it to be at 0.2%. So the market liked that it's not going down necessarily. It's not showing any weakness, but it did come in lower on an inflation basis than what they thought, or last time it came in up 0.3%, where the PPI itself, the headline number, came in as expected, up 0.1%, but down from the 0.2% we saw last time. So here are some charts. Here's the business optimism index, where things are looking a little bit better. And this really could bode well for the economy if this trend continues to show more improvement. Here is the PPI. We look at the rate of change going back year over year, where it's still continuing to go up. And then we look at the 1-month rate of change. The headline number is also going up here. This is the one that the market's really paying attention to. This is the rate of change for the core PPI, where it's leveling off and actually starting to decline, where we did see a little bit of a tick up from the month over month reading. Here's some other charts of PPI, final demand year over year. It shows both the total and the core going down, and the market liked that, but it's not necessarily falling apart. And we look at the final demand year over year, where we're seeing the services going down and goods coming up a little bit here, but that didn't seem to really concern the market. And then intermediate goods processed are kind of flattening out just a little bit above zero. We are seeing a bit of an increase here in the unprocessed goods. And then some Isabel Net blog charts. We're coming down now with our overbought, oversold indicator. We had been well into the 90s as the market was really going up. And then as we've been under pressure lately, we're all the way down to 58.21 now. So we're more neutral at this point, where we had been extreme positive there. And this one, I have to do some kind of manipulation here. When I see this chart, I have to really blow up my screen and then do another screenshot. It's still quite blurry, but otherwise we really wouldn't be able to see what's on this chart. It just says a VIX above 50 is a great longer term signal. It's, again, using it in a contrarian manner, just meaning there's an awful lot of fear coming in here. And so when we get a signal above 50, which we did, we climbed above 50 on a week ago Monday's decline. What happened after that? Well, we were up a little over 0.5%, or half of the time 1 month later. Not quite as good 3 months later, looking a little bit better, up over 70% in 6 months, and up almost 100% of the time looking out 1 year. Okay, and then here is some different charts that are drawn in a little different way than what I do them. I'm not into the island top. I'm not into all this stuff because there's so many different ways that you can interpret this, and there's too much subjectivity into it. But people still do it, and sometimes we can. It doesn't mean they're always wrong. It just means I like to look at charts that they're either black or white. They're positive or they're negative, and there's not a lot of interpretation that you need to do. But this could suggest things are more negative if we're actually seeing some kind of a top here where we came down, we're starting to bounce back up. Now we've actually been able to get above this 5,400 level now. We're coming back up to the 50-day moving average. And so that's actually acting as overhead resistance. I'm not sure if that really negates this, but you can see the downside gap that we had here. Really, both of these gaps have now been filled. The initial gap, and I tried to point that out as it was happening. And then as we were coming up, well, we've now been able to fill this other gap. Is that going to mean something? We're bumping into the 50-day moving average. We're filling both of these gaps. Sometimes when the gaps get filled, we do see a reversal after that. So I'm not really discounting this chart necessarily. There is some good takeaway from this that we can get. All right, and then this thing looks like my goodness, a rainbow lightning storm here. But it's U.S. equities typically trend down to flat in the lead up to a triggering of the Somme rule recession indicator. Now, the perma bears are just salivating over this because it got triggered with the last employment report. We came in it came in with a reading of 0.53. And I follow the person who developed this on Twitter, and she has stated that maybe she's not right this time. Doesn't mean she's not. Just like, I think it was about a year ago when the person that came out with the analysis of the inverted yield curves, and then that leads to a recession. They also came out and said, well, yeah, I know I discovered this, and most of the time it works, but maybe this time it's different. Remember, we're still in a different environment than we've been in with all the stimulus and the lockdowns and what's been happening in the U.S. economy. That's still trailing over into how things are handled even today. But it says not this time. Maybe it's not happening. We are starting to climb up here. And so when this goes above 0.5, and I go through this in the weekly video, that's when we get concerned. That means that unemployment is really starting to go up, and that usually means bad things going forward. And you can see by all this rainbow lightning here that things did tend to decline after that. Is that going to happen this time? Well, we just have to watch and see. We have a lot of different charts that we look at. There's a lot of things that we follow and analyze. So this usually doesn't just change overnight. And if it does, like what we saw with the scenario a week ago, that all of a sudden the economy's falling apart, that just lasted a few days. Potentially, we could be getting beyond that and going back to the more positive environment that the market had been taking on before that. But this does have a really good track record in and of itself, and that's what the perma bears are really pulling for right now. All right, then looking at sector fund flows, not real surprising here. We're still seeing an awful lot of money going into tech. That's where the real growth area is. And then our central estimate. I'm not sure what a central estimate is here. Is it opposed to a decentral estimate or an eastern or southern estimate? I don't know. But at JP Morgan, they're trying to figure out how much does it cost to make Bitcoin. And then they compare that with the current market price. And of course, as long as the price is above the production costs, there are profits to be made there. Or this could really run into a problem is if we see these lines actually cross back over each other. And then rising market concentration, it's not just a U.S. story. Of course, we have the Magnificent Seven or the Great Eight or the Illustrious 11 or whatever you want to do. Well, they have their own thing over in Europe called the granolas. And there's a list of all these companies down below. And some of them, Nestle, you probably heard of. L'Oreal, yes, I use their products all the time. AstraZeneca, but some of these you may not have. GlaxoSmithKline. Okay, a lot of them you probably have heard of then, but they're doing fairly well too. They have been seeing a pullback lately, but this is where a lot of the strength in the European market is coming from. And then this is two different ways of setting up a portfolio where you use discretionary. Now, that doesn't mean discretionary, the sector that we're talking about. That means that you make decisions. If something's going bad, you jump in and sell. If something's going good, you might jump in and buy. So you're making decisions. Where a systematic strategy is you just follow a plan and you stick to that plan and you don't change it. There's really no variation from it. And what we're getting from this is when we saw the weakness and the real decline last week, we saw money coming out of both because there were systematic triggers that were getting people out. And of course, everybody was freaking out. So we had discretionary emotions actually coming in and playing a role as well. And then headline inflation and some common measures of underlying inflation. We're going to be getting later on PCE and core PCE. The takeaway from this is that we're going down with all of these lines. And even the Federal Reserve in Dallas is starting to lower their inflation projections. And this is what the market likes. The Fed wants to get back down to this 2% level. Then looking at weekly high grade fund flows, these are the more high quality bonds. And we're seeing a lot of money going into that. And we're seeing money coming out of junk bonds, which are more risky but give a higher yield, and going into better quality bonds that folks tend to get into when they think interest rates have topped out and that they don't want to assume the additional risk of junk bonds, and they switch over and lock in maturities in a safer type of an environment. And we are seeing an overall inflow of funds there. I didn't get Yardeni's charts. I'm recording a little bit earlier than usual, and I haven't received his email yet. Plus, I did a pretty extensive go through on his email that was for Tuesday, so I'm not going to spend any time there. Just a couple of charts here, and these are repeat charts here. We want to maintain an idea of what is the context. If the Fed is coming in and cutting rates, why? Is it because they want to stimulate the economy, which the stock market likes, and that tends to produce the dark green line here? Or are they coming in and cutting rates because they're worried about economic growth or that we're going into a recession? That's where we see the lighter green line here, and that tends to be negative. And then over the weekend, Chris Schiavocco posted this, which is actually some research from somebody else. And you can go through and see the positive results when the Fed can work with more finesse with controlling the economy instead of reacting to catastrophes. The returns looking out, no matter how you measure this, tend to look pretty positive. And then here he is, and if you watch these videos for very long, I think Jim Cramer is a complete clown and shouldn't be listened to. And if you do watch him, it should only be used for entertainment purposes. But this is what he said, October 6th. A lot of damage done by this sell-off. This was the big decline. Can expect a quick bounce back. Well, look at what has happened since then. I mean, and this guy's a professional and has lots of people that watch his show, and he's wrong so very much. Unfortunately, he's right just enough for people to kind of trust him. So, all right. So we saw most of the not most of the gains. We saw a really good gain from the gap. Now, Monday's session was really calm, and that's why the R levels here are not all that far apart. R3 was up above current price, so I didn't put it on the chart. But we opened above R1. We actually opened up above R2. We fell back a little bit and then just spent the rest of the day trailing higher and closed at the high. So it was pretty positive, other than the fact that we were below average with volume. And we're flat. I checked the futures right before I started recording, and it might stay a little bit quiet ahead of CPI coming out just because that's such an influential report. We're seeing an improvement here, both with growth and value, but the red line is still above the blue line when it comes to the intraday chart. We're seeing a bit of improvement here where you can see ever since we saw the decline, and then we had that big down day after that last week, we are seeing growth making a comeback when compared to value with the S&P. And that could be positive for the market and positive for the indexes. So we were up 2.27% with growth, and we were up 0.91% with large cap value. We were up more with the mid caps, but up less with the small caps. So we're seeing a bit of a bounce here, but not any real breakout. When we look at small cap growth to value, bit of a bounce, but no real big change with mid cap growth to value. Seeing some improvement here, but not really breaking out. We're trying to get back above the 50-day moving average with this growth to value ratio for the S&P. This is rather encouraging, where we actually drop down below the 250 period moving average. When we look at growth versus value, these two ETFs where we do a ratio, this is starting to come back up and showing some improvement. It's not turning positive yet, but it is at least going in the right direction. And we're seeing a little bit of a tick up, but nothing all that great yet with discretionary to staples. Large cap growth was able to get above its 100-day moving average, but it's still below its 50-day moving average. And we're going back up now as the large caps have been outperforming the small caps with this ratio. In our trend, we're dropping below the moving average. The red line's on top, but it's declining. The green line is coming up, but they have not crossed yet. So we still default to negative here, but this suggests a weakening trend. And here's our short-term chart, also dropping a little bit more below the moving average since this one is short-term and it moves faster. We also see the red line declining and the green line coming up, but they have not crossed. We're seeing a drop-off in volume, and that is a concern. As we've been bouncing back up here, we're seeing volume actually well below average. And looking at sentiment, we're coming down a little bit here with the Ulcer Index after it had been giving us some really high readings. We're back down under 20 with the VIX. We closed below the 20 level here, both with the line chart and also with the bar chart. And since the VIX is going down, we're actually going down here with the VIX of the VIX, both with the bar chart and with the line chart here. And we're coming down with the VIX to move ratio. The VIX measures the volatility of stocks, and we do a ratio with the volatility of bonds, which is the move index. It's coming down after both had been really spiking up. And we're actually rolling over now with the MACD as the VIX went sky high here, up over 65. It has been coming down for the most part here. And so the momentum for the VIX is now going down. And we're looking at this seasonal tendency. We could be right about in here where we go really up high with the VIX. We pull back a little bit before it gets set to go higher. We have no idea if that's how it's going to play out, but historically that is what has happened. And we declined with this one fear gauge that we follow. We're also declining slightly here with this other fear gauge. So we're seeing more confirmation there. We're starting to go back up, showing some improvement here with the risk on to risk off ratio. When this is going up, that's risk on. Folks are getting more into stocks that are risky and tend to outperform when we're going up. They get out of those stocks when we're going down, since those high beta stocks tend to go down faster than other stocks. We want to keep an eye on this. It's still giving us a little bit of concern here. This is the spread between risky and not as risky bonds, where we look at an inverted chart here. It actually ticked down just a little bit in the latest reading. We want this to get back up here, which means fear is going down, and get back down to these levels that we were seeing before. And volatility risk premium also dropping off and getting very low right now. Our advanced decline line showing some improvement, but not breaking out yet based on price. We're still lagging behind here as well based on volume. That's the negative side. The positive side is that we are advancing and we're above the moving averages. And we did see a bit of a breakout here with new highs and really no expansion of new lows, but our 5-period and 10-day period moving averages are still continuing to go down. But this internal measure is still holding up fairly well. We're still above zero and going up with the advanced decline ratio. We're looking better now. We're actually crossing back above the moving average now with accumulation distribution. So this is potentially turning back to positive. But you look up on top, and I'll point this out again. You see where we have the 50-day moving average right above current price? That is some overhead resistance now. We're also seeing an improvement here with the chicken money flow. The red line is now starting to turn back up after we had been given a real extreme negative reading. And this is actually turning positive. The Chaikin oscillator has been going up pretty much all along, and it's crossing below the midpoint. So it's switching positive now. And we're right at the kissing point here with the vortex. The red line is just barely above the green line. If you look at the numbers over here, Green is at 0.87, red is at 0.85. So they're what, 0.02 of a point away from each other. If we see the green line cross above, that will be a primary signal that will turn things more positive. But we got really close to that before, where the green line was coming down, the red line was coming up, and then they kissed each other, and then pow, the green line took off again. And we're seeing some improvement here with the NYSE cumulative advanced decline line coming back up to the moving average, but now this moving average is starting to go down. We've been holding up fairly well through this whole mess with the NYSE advanced decline line, and also looking pretty good here with this other NYSE advanced decline line. Seeing a tick up here with the NYSE common stock based on price and the advanced decline line going back up. We're also showing some improvement here based on volume. And when we look at S&P, the advanced decline line cumulative based on price, seeing some improvement there, and seeing more weakness with volume, but also now starting to bounce back. And we still see the red line, the NYSE advanced decline line above the S&P 500. That just means the broader market is still holding up, even though these are on different scales. Showing some improvement again here with the advanced decline line studies. We're going up with the NYSE common stock, the S&P, the mid caps that just barely dropped below the moving average. And we also saw a bounce up here with the small caps. On our short term, we want to watch this 50-day moving average. That's kind of the real point. If we continue to go higher, is that going to act as overhead resistance? On the bottom, you see, as we've been going back up, we continue to be below average with volume. And we're going back up with the 20, 50, and 200 period moving average studies on the S&P. This is a little extreme. The rate of change 5 shows that we've gone up pretty far, pretty fast when you go back over the last 5 periods. So that may suggest we've overdone it. It may suggest that we slow down. It may suggest that we reverse. We just want to keep an eye on this. We are getting extreme positive here with the Stochk RSI, but we're not. We're looking better here with the Williams percent R. This is turning positive with the CCI 14, just about ready to turn positive with the CCI 20. Looking better here with all of our stochastics charts, but none of them are extreme now in the short, intermediate, and long term. The condition of the 20 period moving average is looking better. We're staying above both of these lines, and now the lines are starting to turn back up. And we're just a little bit above the 20 period moving average. Now we still have the 50 that we have to deal with, but because of this decline, the 20s dropped below the 50s, but we are getting a little bit back above the 20 period moving average. The force index, after being really negative, is now going back and actually turning positive. And we're getting above the midpoint here in the +1 channel with our standard deviations chart. Balance of power starting to turn back positive. We're looking extreme positive here with the Connors RSI. We're still looking at the lighter shade of purple here with the go, no go, but it's showing some improvement after being the dark, deep purple. And we're coming above the midpoint here with our highest high, lowest low value chart. So that's showing an improvement as well. We're coming back up to this shorter term anchored moving average, which is right around, it's marked down to a low that we set back in April and into May. And this is right around the level of the 50-day moving average. So this is also suggesting there could be some overhead resistance. And keeping an eye on this, where we had declined from the top in July all the way down to the decline that we saw last Monday, a week ago Monday, and we've been bouncing back up right here. And this is another point to look at, where we came back up and we closed this gap. Well, now we've closed this other gap. Is that going to mean anything? Sometimes it does. Now that these gaps have been closed, we've come back to this level. This could suggest a reversal, but if we continue to go up, then things would switch back more positive. And the TTM squeeze is no longer extreme negative, but it's still negative since it's red, but it's the lighter shade of red and no longer below the black line. We're coming down a little bit here with standard deviation over the last 10 periods because we've been moving pretty fast with price. We're looking better here with the ease of movement. We're no longer extreme negative, but we're still below 0. And we're just flat with the Arun. It's like, what? Something's going on. I'm on vacation. I'm at the beach. We are turning back positive with the S&P McClellan oscillator. We were able to cross back above 0. So we're starting to turn up based on price, and we're starting to turn up based on volume. So that is looking more positive. We also were able to cross back above zero with the NYSE McClellan oscillator, so that's turning positive. You can't really see it here, but the summation index based on price and volume are starting to tick back up. We are positive with the Swenlin trading oscillator. We're above zero based on price and volume. That's encouraging. We're trying to turn up with momentum, but we're still negative there, turning up based on price and volume, but below the moving averages. So seeing an improvement here with the PMOs that are rising, a little bit of an uptick with the buy signals. We're still flat with the PMOs that are above zero. And we've gone from neutral to positive now with the Elder's impulse system for the S&P, but we're still negative with the parabolic SAR. And we're starting to turn up and actually looking somewhat positive here with the slope oscillator. We're back above the moving average after getting a really extreme negative reading. And we're trying to turn back up, but not above the moving average yet with the MACD. So we're looking better in the short term with our oscillators. We're showing some improvement here in the intermediate term, but we're still declining with our longer term oscillators. And the 50 period moving average condition right now is looking a little better. We've been able to get back above the triple exponential moving average. The real trick is going to be, can we get above the blue line and stay above it and see the lines turn back up? And then for it to turn even more positive, we want to see the red line go back above the blue line. And here is the 50 period moving average. We have it, the simple moving average. We blew through the exponential one, but most folks tend to use simple moving averages. We're just a little bit below that currently. And we're still looking better here with the 100 period moving averages. We fell down below it. This had been providing resistance. We were able to come back up. And as long as we can stay above this, that will be more intermediate to somewhat long-term positive. We're seeing an improvement here with the Sean trend meter, but not extreme. So here are all of our moving averages. We're above the 20s, but now we're having to deal with the 50s here. And we're looking a little better with the bullish percent index. This actually turned positive after Monday. We crossed back above 50. Now we're continuing to go up. So there's a lot of point and figure buy signals being generated inside the S&P, which is showing internal strength. And we're turning back up, but not quite positive yet with the NYSE bullish percent index. We've turned positive now with the NASDAQ 100 bullish percent index, as we're potentially going back to the mega caps and the large caps seeing more favor in the market right now. We're crossing back above the midpoint with the money flow. We're going up, but still below 50 with the ultimate oscillator. We're back above the moving average with on-balance volume. We're still below the midpoint here at 50 with the stocks inside the S&P above their 20 period moving averages, but we're showing some improvement with the 50 period moving average steady, the 100 period moving average steady, and the 200 period moving average steady. We're trying to get back above the midpoint here with the RSI 14. So that's more intermediate term, where the short term is crossing back above the midpoint as well. So this is looking more positive as well. And we're trying to cross back up, but not quite above the moving average here with the Copic curve. And we're still waiting to see what kind of a signal will be drawn in here with the mass index. 2 out of the 3 parts of this signal have been triggered. We're waiting for the third one. We're still looking more negative here, but this is longer term. This is the 10-day average of the S&P 500 highs minus the lows. This continues to decline. It's picking up that weakness that we had been seeing. At some point, if we continue to go up, we should see an improvement of this indicator. And we're coming back up into the mini rainbow with our 20-period moving averages here. And sometimes when we're coming up, one of these areas may act as overhead resistance. So we're keeping an eye on that. And looking at the fib extensions, we're crossing back above the 38.2% fib extension level for the S&P or SPY. We're still negative here. The red line is still above the blue line on this chart, but we're still inside of the Ichimoku cloud. If we can break out of the cloud, see the blue line cross back above the red line, that will be positive. We are seeing some improvement with the green line as it's going back up. And this is encouraging, well, either encouraging or discouraging. We came down to this R1 level, and that support level is held, but we're bouncing right up to this R2 level again, which could also be acting as overhead resistance. So we're dealing with the 50-day moving average on the daily chart. We're dealing with this R2 pivot point on the weekly chart. And we're seeing a bit of a mixed picture here. The Heiken Ashi is looking more positive. We're turning back positive with the Kigi chart, but we're still negative with the Renko chart. but we are looking a little more positive with the 3-line break. We had enough of an up move to see a new X drawn in. We're working off of a low pole reversal, which was triggered back on August. That's really hard to read. 9th. Okay, longer term, seeing some improvement with our 150 and 200 moving averages here, getting a little bit close to this extreme line. I have it marked at 350. This is at 349 right now. This is one of the extreme readings. Going back 200 periods, the rate of change, we're starting to get a little extreme here. This could suggest good momentum, but other times when we had a really high reading like this also marks some exhaustion. And if you look at the last time we saw this, it pretty much marked the top before we started to descend after that. And we're seeing some improvement here with our Keller market model. We're turning back to positive in the short term with the S&P and the NASDAQ 100, where the mid caps and small caps are still in short-term downtrends. We're in an intermediate downtrend. That's because the 20s fell below the 50s with the NASDAQ 100. And we're still looking negative across the board with commodities, and now the dollar's looking negative across the board, where stocks and bonds based on price are positive. And lots of green or blue here. So NASDAQ just breaking out, S&P getting above 5,400, getting above 50 with the BPI. We are seeing healthcare crossing above 50. That's more defensive. The NASDAQ was able to get above 17.1. We had the tech sector, though, have a bullish MACD crossover, and that's positive. We're seeing some favor coming back into tech, where at the beginning of the day, communications also saw a bullish MACD crossover. So we're seeing more money going into the areas that have really been pushing the market higher, at least as of Tuesday. And we're turning back positive here with the new highs minus the new lows on the NYSE. We had dropped negative and we were down there for a few days. Now we're starting to come back and turn positive here. And we're seeing the red line above the S&P bar chart. That's just showing that the equal weight is holding up fairly well right now. And we're continuing to see this ratio go up, meaning that when you compare them on a ratio basis, the big stocks are still outperforming. And that's what helps the indexes to go higher. But when we look at the previous chart, this red line going up means that the rest of the S&P is still hanging in there as well. And we were able to get above the 50-day moving average here with the Dow and above this S1 pivot level here, which had been acting as resistance. That's positive. And we're switching over to positive with the Elders Impulse system for the diamonds. We're able to get above this S1 level with the NASDAQ. Now, we still have the 50-period moving average for the NASDAQ to deal with as well if we keep going up. And we're also breaking out here, but have the 50-day moving average above current price for the NASDAQ 100. But we're turning positive with the Elders Impulse system for the QQQs. We are able to close just a little bit above the 20-period moving average here with the Qs, but we're still seeing the 20 below the 50, and that has caused some damage to the short-term trend. We're turning back up, but we're not quite positive yet with the NASDAQ 100 momentum. If we cross back above the moving average, that will show a real improvement. And we're seeing an improvement here, but we're not back up to the 23.6 fib extension level for the Qs. And small caps are up, and they've been hanging in there fairly well. We'll see if that continues. They're back above their 50-day moving average here with the S&P 600 small cap index. So that is more positive, and they were up 1.68%. But we're right at the 50-day moving average when we look at the Russell 2000 small cap index. We're showing some improvement with the RSI at the 50-day moving average, but the momentum is still negative. And we continue to be neutral with the small caps when looking at the Elders Impulse system. We're coming back down a little bit here with the small cap to tech ratio. If we want to see the market be more tech favored and the NASDAQ 100 and the S&P 500 really be able to go up, we want to continue to see this ratio going down. And that's what it's doing currently after really going up. We're still below the 50-day moving average with the mid cap. So we haven't been able to break out above that resistance level, but we're above this S1 pivot point here. But we continue to be neutral with the mid caps when looking at the Elders Impulse system. We're just below the 50-day moving average with the Wilshire, a broad market measure. We're also just about at the 50-day moving average with the total U.S. stock ETF. So not only is the S&P, but we're seeing broad market measures coming together at that 50-day moving average with a major economic report coming out. So It's no coincidence that things are all converging right now. The FANG index is still pretty far below its 50-day moving average, but has been improving after bouncing off the 200-day moving average. And so we're coming up to the underside of this trend line that's trying to connect these lows that we've seen. That may also provide some overhead resistance. And then the staples to tech ratio continues to come down. That's when tech is favored, when we see this ratio continuing to decline. Financial sector, we're breaking out a bit above the 50-day moving average, and this sector is holding up quite well. And we're seeing a decline here with the US dollar itself. Even though I had it as unchanged, we were actually down. Apple was up 1.72%, breaking above its 50-day moving average. Amazon still having trouble getting back above its 200-day moving average. Microsoft has been able to get back above its 200-day moving average. Google bouncing up, and you see where all these stocks are up. We were up 2.44% with Meta, breaking out above its 50-day moving average. NVIDIA had a good day, up 6.5%, but still below its 50-day moving average. Tesla was also up 5.25%, also bumping back into its 50-day moving average. Netflix was up 2.36%, also bumping back into its 50-day moving average. You see how all these things are coming together here? And it could be really positive if we break through, just like Jim Morrison said, break on through to the other side. But this could also act as overhead resistance that could really form a formidable wall above current price. We're still negative here. When we look at the broad market with the 5-day moving average of the highs minus the lows, we're still below zero. And we're still seeing a pretty strong short-term correlation between US stocks and world stocks, and a strengthening relationship with the longer-term correlation. I want to keep an eye on oil. It was down over 2%. So it's not really spiking up due to geopolitical reasons, at least yet. And I take that as a good thing. I'm supposed to be going to Israel here in a few weeks, and I would rather not spend my time dodging nuclear weapons or any kind of bombs for that matter. All right, looking at the 10-year yield, we are declining, and the market seemed to like that. We're going up with the 10-year based on price. And I wanted to break out the stock to bond charts here just to see how we're doing with these. I went over a lot of them on the weekend, but now that we've had a couple of trading days, I wanted to show this. We're coming down when we look at bonds versus stocks, and that's what we want to see. We want to see this ratio declining if we're more positive on stocks. Looking at the S&P 1500, a broad market measure to short-term bonds, still in the rainbow, but bouncing back up. And you're going to see an awful lot of that here. Another broad market measure with 3 to 7 year bonds in the rainbow, but improving. The tech sector to 3 to 7 year bonds in the rainbow, but improving. We're still declining here when we look at riskier bonds, junk bonds, versus more conservative bonds, as folks are trying to figure out, do they want to get out of the riskier bonds and give up that good yield and get more into government bonds, which are safer, but don't give as high as of a yield? And we're seeing a decline here. Now, we have to look at the context. Now, when we were crashing down here before, it's because the economy was supposedly falling apart. Are we declining now because the economy is doing okay and the Fed's going to cut rates and that's going to help the economy going forward? We're starting to potentially see a shift back to the more positive scenario now when we look at 1 to 3 year bonds versus 3 to 7 year bonds. And we look at the Qs, the 3 to 7 year bonds, bouncing off the 250-day moving average, but still inside of the rainbow. And we're still going back up with this idea that maybe we're going to hit a soft landing after all. Now, we were coming down through the rainbow there for a while, but now it's starting to go back up. And we look at TIPS, Treasury Inflation Protected Securities. They are back to underperforming 7 to 10 year bonds. These tend to go up when there are inflation and interest rate concerns. They were coming down maybe because the economy was falling apart. Now they might be resuming a downward move because things are not as bad. So you have to look at the context of things. Home construction really breaking out, then came back into the rainbow, starting to show a little bit of an improvement here when we do a ratio with 3 to 7 year bonds. And the Eurozone, it fell down below the rainbow. Now it's trying to get back into the rainbow when we compare it to 3 to 7 year American bonds. And we're seeing some improvement, but no real breakouts yet when we look at our growth to value ratios here with the Qs to S&P back up to a declining moving average, Bit of a tick up with discretionary to the S&P, breaking out a little bit above the moving average with large cap growth compared to large cap value. But we want to get above this and see the moving average turn up to be more positive. So we're seeing some improvement with the large caps, mid caps, small caps are also trying to break out above the declining moving average. Going back up a little bit here with our S&P to utilities ratio, if this can go back and continue to go up, that would be more positive for the S&P. Looking more positive here with our advanced decline ratio. We're above zero based on price, and now it's being confirmed based on volume, where we were seeing a negative divergence after Monday. Starting to come back down with our staples to S&P ratio, and that would be more positive for the S&P. So what's our outlook for Wednesday? We're still negative, but showing signs of improvement along the way. You could even make a case that we're starting to turn over positive. But until we clear all those 50-period moving averages, we need the market to prove itself to us right now. We're going to get the MBNA Mortgage Applications Index, and the biggie is going to be CPI, and then all the geopolitical craziness going on that can impact the markets at any time. And then on Thursday, we're going to get retail sales, industrial production, and capacity utilization. Then we're going to get consumer sentiment on Friday. Here is a look at the economic calendar again. Seasonality, we're positive with the Dow and NASDAQ. We're neutral to positive with the S&P for August 14th. And Wednesday tends to be the most negative day of the week based on how things went in 2023. And we are on the 10th trading day of the month. We do see a little bit of a positive bounce here, and we might see a little bit of a pullback to sideways action before we might up thrust into Friday's options expiration. And then we're wondering where we're at here. We were getting way ahead of this. They're trying to compare 1968 to now because there are a lot of parallels between the craziness that was going on then with the craziness that's going on now. So we'll just have to see. They could be kind of going more in line with each other these days. And we're also looking at 1987, but we're starting to see a real negative divergence between the two. They were kind of going in the same basic direction here. And then, of course, here's the 87 crash. You have all the perma bears. They just know that's what's going to happen. But we look at facts and what the charts are telling us, and we're not really seeing how these are really mirroring each other at the present time. And then even when the president doesn't run for re-election, the market still tends to do well, but September can be a problem at times based on this seasonal chart, as well as this seasonal chart, and this other chart where you take August through October together. That tends to be a rougher period of time. Even, I think this is during an election year as well. But this, when you take August, election years tend to do pretty good in August, but look at September. All of them are down. Okay, so what are our warning signs? Still keeping an eye on those defensive sectors, staples, utilities, and healthcare. If energy pops more for geopolitical reasons, that would be a concern. We're seeing some improvement with growth of value as well as discretionary to staples, but we need to see more than what we're seeing right now. And accumulation distribution, not positive yet, but could be in the process of turning positive. The Chaikin money flow is showing some improvement, and I like to keep these three together because they're smart money indicators that we use as a bunch, where the Chaikin oscillator is actually turning positive. Parabolic SAR is still negative. Ease of movement is negative, but showing an improvement there. Our oscillators, the short and intermediate term, are trying to turn back up. The long-term oscillators are still going down. Ultimate oscillator is showing some improvement. The Copic curve is trying to cross above its moving average. The bullish percent index for the NYSE, it's still slightly below the midpoint there, but a good day could really help that. Positive signs, a little bit longer list. I don't know about the equity put call ratio. I'm recording earlier than usual, and those charts update so late, so I'm not really sure what's happening there. And the advanced decline lines are holding up. We were seeing a little bit of concern here with the mid caps. That seemed to help things a little bit on Tuesday. And the S&P and NYSE McClellan oscillators, these are switching back over now, and both are positive. And the Swenlin trading oscillator is back to looking positive, both based on price and volume. The bullish percent index for the S&P has crossed back above 50. The money flow is now above 50. The vortex, it could be turning positive. The two are kissing each other. We'll see if the green line can go above the red line. The financial sector is looking pretty healthy. And the bullish percent index for the NASDAQ 100 is turning positive. It crossed above the midpoint there. So our conclusion, we're negative, but we're possibly turning positive. We need to see what CPI is going to do to the market and how the market's going to react to that. And we want to see what Wednesday's like on a closing basis, if we can get above those 50-day moving averages that I tried to point out on multiple charts. So we're potentially turning positive here in the short term, but for right now, we're still negative. That's what we're seeing in the intermediate term, but we continue to be positive in the long term. Thank you. I really hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.